By May 2026, tech investors face a specific structural trade-off. Achieving mid-teens growth requires significant tech exposure, but buying directly into the AI infrastructure layer means accepting extreme concentration premiums in a handful of megacap stocks. The computational scaling required for AI is immense, but as of this quarter, pure-play leaders are trading at 35 to 42 times forward earnings. This creates an opening for a tactical equity sleeve. We are modeling a portfolio designed for a 17.8% 5-year compound annual growth rate, with a managed beta of 1.18 and an estimated Sharpe ratio of 1.35. While pure AI leaders demand those 40 times multiples, this blended tactical approach targets a forward PE of roughly 26. This chart compares the valuation profiles. On the left, the premium for pure AI exposure. On the right, the blended tactical portfolio trading at 26 times forward earnings. This gap suggests that 2026's outperformance may depend on identifying the specific physical bottlenecks that allow this compute layer to scale. To test this, we use a 33-holding tactical equity sleeve constructed from a high-conviction universe. This breakdown shows the portfolio allocation across 5 strategic buckets. The core is a 30% allocation to AI and data infra, supported by 22% for energy transition. The remaining pieces are 24% critical minerals and 14.5% robotics and autonomy. This framework shifts capital from purely digital assets into the physical infrastructure and raw materials required to sustain them. Our objective is to construct this macro model from the ground up to determine if it can achieve aggressive growth while engineering a floor against market drawdowns. We begin with the portfolio's core growth engine, the 30% allocation to AI and data infrastructure. These specific holdings currently dominate the AI buildout. The table highlights our weights for NVIDIA, TSMC, and Microsoft. The technological moats here are specific. NVIDIA is driven by the Blackwell ramp, while TSMC maintains leadership in 3nm and 5nm nodes. However, this digital layer faces a massive physical limit. Data center power demand is projected to increase tenfold by 2030. Scaling compute clusters requires vast amounts of baseload electricity and industrial cooling. This brings us to the 22% energy transition bucket, the non-negotiable solution for hyperscaler power demands. Within this bucket, we identify the utilities and energy companies poised to capture that demand, specifically NextEra, Vistra, and GE Vernova. Hyperscaler power purchase agreements are now driving massive, predictable growth for these utilities. The 24/7 power requirement for AI is also driving a nuclear renaissance, with small modular reactor commercialization expected by 2028. From a structural perspective, holding the AI compute engine requires owning the baseload power generation that keeps it running. The next bottleneck is hardware. Scaling power grids and compute clusters requires an exponential increase in physical copper and cobalt. This is the physical reality of the resource extraction required to meet those digital targets. This drives the 24% critical minerals allocation. Analysts project a severe structural deficit of copper starting in 2028. We focus on mining equities like Glencore, Ivanhoe Mines, and First Quantum to capitalize on this deficit. These miners show strong financial health, with Ivanhoe reporting 46% EBITDA margins and a ramp-up at its Kamoa-Kakula project. The primary alpha generator in this bucket is the friendshoring premium. 12 to 15% of the total portfolio's effective exposure relies on Africa-centric operations, specifically in the DRC and Zambia. We are tracking the supply chains routing critical minerals from African mines directly to Western technological hubs. Western offtake agreements de-risk these operations and secure a 10 to 15% traceable premium on the sale price. Geographic supply chain dominance in physical metals has become as critical as technological dominance in silicon. We must also address the defense mechanisms. In a potential 2027 global recession, how does a tech-heavy model survive? This chart visualizes the portfolio's revenue resilience. Over 70% of total revenue comes from contract-backed streams. The majority of this revenue is insulated from consumer discretionary spending. Those contracts range from 10-year power agreements to government mandates and defense contracts. Multi-year utility agreements and government offtakes provide guaranteed cash flows, even during a downturn. Our model shows this structural insulation provides a 4 to 8% absolute return floor, significantly mitigating downside risk. 80% of these holdings are further protected by balance sheets with net debt to EBITDA ratios below 1.0. Risk-adjusted alpha is engineered by securing the non-discretionary revenue streams underneath the tech sector. The final stage of the AI supercycle is the application layer, physical automation and robotic inference. The 14.5% robotics and autonomy allocation targets humanoid mass production and large-scale warehouse automation. We gain this high upside exposure through key equities like Tesla and Symbotic. Management of this sleeve relies on the strict quantitative discipline of our war room mechanics. This is an active strategy. We use predefined exit triggers to manage regime shifts dynamically. For example, if copper prices drop below $4.20 for 90 days, we reduce the mining weight and rotate capital into the energy transition bucket. This rules-based approach removes emotional bias from high-beta tech investing. This completes the tactical framework, showing all 4 supercycles unified. This holistic view shows the integrated strategy in full detail. Achieving high conviction in emerging tech does not require discarding valuation discipline or accepting market-level risk. By targeting the physical dependencies of the AI supercycle, capital captures asymmetric upside with managed downside. The emerging winners of tomorrow are the physical entities providing the power, the metal, and the machines required to turn digital algorithms into physical reality.